Dave Sifry, welcome to Built to Sell Radio.
John, it is such a pleasure. Thanks so much for having me.
It's not every day that I get to speak to a 9-time founder. That's pretty cool. Where does the entrepreneurial bug come from? Like, where did this sort of start?
It's such a great question. My wife will say it's more of a curse than a blessing, but I think it just comes from deep within. That if there's something I've learned, I'm not the greatest engineer in the world. I'm also not the best people person in the world. Oh my God, I met some people who are amazing people. And I'm not like the best salesperson in the world. But there's an interesting thing around, like, if you're a nerd like me, which is kind of, yeah, and then I love helping to solve problems for people. And then I love like taking that, I can't help but just evangelizing that. The world has all sorts of problems, and there's like a ton of ways of building something where 1 + 1 = 5. And that, to me, I can't think of a more fun challenge than that.
And you've done it a bunch. People might know Technorati if they've been in the internet world for a period of time. Linuxcare, Offbeat Guides. I mean, you've had a whole string. I guess maybe Technorati would be a place for us to start. Like, maybe talk again. A lot of people may have heard that name, probably vaguely knew what it did or doesn't, just maybe walk me through the kind of origin story of Technorati and how that played out for you.
Absolutely. So this was way back in the day when dinosaurs roamed the earth, and, we were fighting with Neanderthal and 2004. And there was this really incredible thing. The internet had taken over. We were starting to talk about this idea of Web 2, right? What happens when you're actually operating now in a world where it's not just building out infrastructure, but what does an internet first kind of company look like? And the idea of social media, even the whole concept of social media, was a relatively new concept. God knows, like, there was no official job title called influencer at the time. Okay. So, for all you folks who are all like, you want to be influencers, it's great. Like, this is one of those jobs that literally didn't exist at that time. But there was this very nascent form of being able to publish something to your own website. There were some programs that allowed you to do it. We called it blogging. And what Technorati did was I realized, sitting here actually in this office, that there was an opportunity here to be able to index all of that content, and you didn't have to wait weeks. See, back then, all of that search indexing would take weeks, and we would even have what was called the Google dance at the time, where like people's search rankings would get updated because Google, which was the big search engine, was constantly changing things around. And the really interesting thing that I realized was available was that we could start to think about the web not as this big library, but actually as a set of conversations that were going on. And so what Technorati did is it took all of that information, would index anything that you posted within 60 seconds of when you posted it, and then make it available in a very conversational format. So you could see, I wrote something and then you replied on your own site and then somebody else replied there, and you could start to see this conversation forming. And it was a very powerful concept of, we called it the live web back then. And so Technorati very quickly became known not only as the place where, honestly, if you were just looking for vanity, you just wanted to know how many people were talking about me at any given time. But we also realized that then it became very clear that the idea of having a neutral ranking site that could show you what are the most popular technology blogs or business blogs or political blogs or creative writing, what have you. And then from there, the business really expanded into becoming a network and a way of being able to help advertisers find those influencers
And you
be
raised a
able
truckload
to
of
pay
money,
them.
right? Like you rose. I want to. I somewhere in my notes I said you raised some money for Technorati. Is that right?
We did. So we went the venture route. And this, by the way, was back when AWS didn't exist. There was no such thing as the cloud. So in order to be able to do that, we had to go and rack and stack inside of ISPs and buy hardware and do all of that. So we raised about $70 million from a bunch of different venture capital firms, including, over a number of rounds. And we had, people like Draper Fisher Jurvetson, DFJ. We had people like Mobius.
That sounds like a fancy firm.
Some very, very high end. Yeah. Some very high end technology venture firms, right? People who, Reid Hoffman, the founder of LinkedIn, was one of our early investors, right? So we had a tremendous approval and cachet inside of the industry. And we had a ton of attention as well. And it was great because it was an opportunity to be able to be of service to literally these millions of people who were exploring this new form.
Hey, it's John. Look, if you're building to sell, I want to let you know about a resource you may find helpful. It's called the Value Builder Score, and it will evaluate your company in the same way that acquirers will look at your business. It'll give you a score on the 8 factors that drive the value of your company. You'll also get an estimate of value and things you could do to improve that value over time, whether you want to sell now or in a decade from now. Knowing how the movie ends, I think, puts you in the catbird's seat, gives you all kinds of negotiating leverage. So it's available exclusively through a Value Builder advisor. So talk to your advisor. If you don't have one yet, you can go to valuebuilder.com/score. Let us know what industry you're in, and we will connect you with an advisor who specializes in companies like yours. Just go to valuebuilder.com/score. What's that like to have so many mouths to feed? Like, I'm thinking of for a lot of our listeners, they may have raised some money, they may have an investor, and they probably have a little bit of a love-hate relationship. Like, kind of remember back to the halcyon days where they owned 100% and they could do whatever they wanted. And now they've got maybe a partner or like one investor. Maybe some people are still independent. There's no investment at the table and they're wondering, maybe I should raise money or sell some or a chunk. I guess I've never talked, maybe I have, but I can't recall someone having talked or having raised so much from so many different firms. All I can imagine is like the herding cats at the board meeting of trying to get everybody to agree and sort of trying to sort of placate everybody with competing agendas. Like, what's that like to have so many investors investing in an idea of yours?
Yeah, it's a great question. I mean, again, understand that. So we had a number of different rounds of financing, and at each of the rounds, I mean, in the angel round, it was, a bunch of very high net worth individuals. But once you then raise what we call the Series A, right? So that's your first preferred share round. It's generally led by one of the venture investors. And then there are others that follow on at the same terms. And so you don't have to worry about the 8 different companies or the 8 different investment groups who all came in. That one primary investor will have a representative who will end up sitting on your board. And so
interesting. So that's the person you're interacting with daily, giving your
most of the time. And of course, doing good investor relations, like this was also something that I had to learn how to do well, right? How to still communicate with not only my board, but also some of the smaller investors and some of the early investors, and how to take advantage of the fact that these were also incredibly smart people who had great connections. And it didn't matter if you only invested $100,000. If you knew the right person to talk to inside of AOL or inside of Yahoo or wherever it was, that could be an outsized indicator of your worth. And so maintaining good relationships with all of our investors became a skill and an important one as the CEO, because they're the ones who they're sort of buying into, and learning how the CEO role also implies that, partly my job is, yes, to help lead my company. But if I'm not hiring phenomenal people to actually run the company, then the other part of my job, which is great recruiting, good board management, making sure that if we were raising more money, that, that we were hitting our KPIs and talking to the right investors for that next round, that was also a unique thing that only the founder and CEO could do. I wouldn't necessarily advise it, even for most people. I do think that venture capital is an incredibly powerful part of the system. But most companies, and honestly, like, I've raised money 4 times and I've also not raised money 5 times. And I think the idea of raising money is, if I'm really being crude about it, right, you can look at, especially venture capital, it's a little bit like understanding what are the expectations that come with the money. And here's the deal. Like, people celebrate, oh, we just raised $10 million from X, Y, and Z company. Well, guess what you've just really done is you've now reset expectations for your exit value. So you need to understand that now you have a new set of people who are investing in your company. And even if you, the entrepreneur, still owns a majority share, they get certain rights as preferred shareholders. Often,
describe that.
One of those. So
in
again,
your case,
it's a little bit dependent on each of the different deals and how much power you have and so on.
I mean,
but
share with Technorati, like how you guys.
Yeah, Technorati, like we went through some very, very what we considered standard terms at the time. Okay, so the first is the idea of preferences and participation in the deal. And I'm getting a little nitpicky here. I'll get to the voting stuff in a minute, right? But essentially, what that says is at the early stages, the new investor gets veto rights over whether or not you're able to sell the company. And what they're looking for is a return on their investment that is going to fit their particular investment philosophy. And a good rule of thumb that I was told, and that I certainly found in my experience, is that you should expect that whatever valuation they're investing in, like at a minimum, you should expect to see they're not going to be interested in selling unless they can see at least a 5x return on that valuation. So if you raised $10 million on a $30 million valuation, well, guess what? Like, your expectation for exit is now $150 million minimum. And what they're really looking for is 10x or more, right? The venture investors don't make their money on a 1x, 2x, 3x return. Most of their companies fail. So what they're looking for is the one company in 10 or 20 that's going to return 20 to 50x of the amount that they invested. Yeah. So here's the really interesting thing. So as a business person, I am thinking about the business physics of a pretty standard business. I'm thinking, great, like, what's my customer acquisition cost? What's the lifetime value of my customers? How are we growing? How much does it cost? What's my revenue per employee? Like, all of these very standard kinds of things that we think about when we're valuing a company. But in the venture world, this is why you'll see companies that aren't making any money at all. In fact, they're intentionally leaning in to lose money because they're spending so that they can either get more users or get more customers and, then raise their valuation to the point where somebody else comes in and says, oh, I got to have this, or I want to buy it, or they go public on the public markets. And it's just a very different way of thinking about the business. So the expectation is no longer build a great, stable business. Their expectation is build a growing business.
So how did that impact you, having those board members whispering in your ear, Dave, but yeah, we got to 10X this thing. Like, I'm assuming that just put an enormous pressure on you to swing for the fences.
I'd say no question. And one of the biggest things that, and I think was a mistake that I made, if I look back on it now, is what I've learned about, like, what kind of a business do I have and how many employees do I need in order to be able to run this business? So therefore, like, what's my operational costs going to look like? And when I'm not looking at it from the growth perspective, but I'm saying, okay, I'm seed strapping or I'm bootstrapping, right? Maybe you take a small amount of money just to be able to get things going. But like what I always wanted to do was, and what I'm like doing with my current company right now, is really understand, while I'm still really small, how much each part of my business is going to cost, how much revenue, what does that pricing look like? How do we actually build as quickly as possible, if not a profitable business, an understanding of all of the main knobs and levers that will cause this business to be successful. My customer acquisition cost, my lifetime value, right? All of these very standard things. With Technorati, there was such a race to be the one who owned the Google of the space, that the idea was, no, you've got to, everybody's got to become aware of us. So you got to be everywhere all at once. Well, that costs time and energy and communication and the number of conferences that I was going to and so on and so forth. I mean, we had a very nice strategy at that point of being thought leaders. But guess what? That's now 30% of my time and some of my executive times, going out and talking to the press and so on, not focusing on the business. Some of that is you've got to scale whatever it is that you have, even though the amount of revenue that's coming in does not pay for those new employees. And this is where things got really tricky. So in the tech space, for me, like, you can very often, like, we could very often build, I built it by myself and then, brought in a couple of people. We had maybe 5 or 6 people, and it was about scaling some things and getting some operations going. But now I got to hire, some salespeople. I've got to hire more engineers, and those are all really expensive and all way ahead of revenue. And I don't have a clear idea yet of, will the product that we've built scale as quickly or even quicker than the amount of cost that I'm going to be incurring? And that's the big bet that we were taking at Technorati, was that by recognizing that that we were in a winner takes all moment, that if we built out very quickly, built out a really powerful brand, built out the services that people needed, like that, for example, bloggers weren't going to sign up with 3 different advertising networks or influencer agencies. They were going to sign up with one who was going to own 80% of the market. And so we needed to build everything that we were going to do to be able to attack that and own that 80%. And once we had them, then we could grow as they grew. And that was a fundamental strategic bet, as compared to, let's build a really good, really understandable business. We'll stay relatively small, and then we'll grow as the market grows. And very, very, very different kinds of cost structures.
What was the final result at Technorati? Like, how did it all kind of end?
Yeah. So, I mean, I'm taking you very quickly through it, which is we thought at first it was going to be about like search advertising. And then we realized, nope, it wasn't about search advertising, right? Like sort of like Google AdWords or AdSense. Like, that wasn't it. That in fact, the network was in fact the real business here. And it took 6 years to be able to come to that conclusion. And at that point, I realized, oh, great, I'm a terrific technologist. Like, I'm a blogger. I love what I do. I've never built an advertising network before. And so we brought in a new CEO who I helped recruit, a guy right out of Fox Interactive who's absolutely terrific, who then ran the company and ended up helping us sell it after 11 years. So it was one of these, 11-year startup stories where, we built this business that did turn into a really good sustainable business for our partners. And it looked nothing like the business that I thought it was going to be when I was building it here in my basement.
How did it work out for the investors?
Yeah, we made the investors whole, and I think that again, this was one of those really interesting questions where, I could have sold earlier when we were still in that more promise than reality stage. And things were very full of hype. And, I look back on it now and I thought, wow, had we sold, we had an offer for almost $100 million. And this was back when we had raised, less than 5. But things were so hot and we were, that I kind of let my ego get in front of, the reality. And if I look back on it now, I would have had a better outcome both for myself and for my investors. I mean, we would have had fewer investors, but I would have had a better outcome for those investors had I taken that earlier money, the cash off the table. But in the end, I think we built something that had some sustainability that was able to sustain and still be able to do all right. Divide that out by 11 years of your life. Not sure that I would have taken the same deal. But again, no one knows what the future holds. And so I look back now and I say, I think I made the best decision that I could make at the time. And what the best part of this was to say, wow, looking back now, I think I have a much better idea of what are some of the different things that I would have done differently when looking at that early offer. That I probably would have changed my mind.
Yeah, I'd love to know, because a lot of our listeners are at that fork in the road, right? Where they're like, things are going well. Tomorrow's going to be better than today. Yet there's that sort of voice in the back of their mind saying, oh, geez, I don't want to write it over the top. I don't want to. What would you do differently if you had that to do over again? What sort of advice can you give our listeners?
So the single biggest mistake I made was putting my ego into it too much.
In what way?
I thought that it was about me. It's not. That my job was to be of service to the company and to the investors, and that, not about my own personal aggrandizement. And I think that I was just young and stupid, and maybe not stupid, but just I was young and wasn't thinking about things, right? You always think about how great it's going to be and it's only going to get better. And that is true. It sometimes does work out that way, but fate is fickle. So if I was making a different decision, first of all, I think I would have relied upon my trusted advisors more closely. So I did have people who I talked to, but I didn't involve them into some of those deeper parts of the business in the way that I do now. Right. So today I have a brain trust of people who I talk to who understand all of the different parts of my business. They understand what I'm doing and why I'm doing it. And so when I was back then, I didn't have hey, you know what, this number, because of where we are and the dilution and so on, this would be a life-changing amount of money for me. I just kept saying, no, keep betting, keep doubling down, because it's only going to be better tomorrow. And I had advisors who were saying to me, you know what, Dave, that's true. But sometimes it's smarter to just, take the money off of the table. You've only been doing this for a couple of years. That's a lot of money for only 2 years' work. And it will put you and your family into a very different financial position. And then you can always raise more money or go off and do the next thing. And I think that, again, just having that perspective from some trusted mentors and then, being mature enough to listen to it. Those are some of the mistakes that I look back on. Now, I don't look back with regret, because at the time, my gut feeling still said, to hell with it. Like, let's go. This thing is just going to do great. So, I would advise myself, looking back on myself, build up those trusted connections. Come to grips early on when I'm starting the business and when things are really, really small. Ask myself, what would my number be that I'd be happy enough? And in what does success really look like? Because I did the classic trap of like just moving the goalposts as things got better and better. And, looking back on that now with more experience, it's like, they say, take the win. I think there's something to that.
I think some people, though, feel like and are in fact told that they are quote unquote selling out, that they're just money grubbing entrepreneurs in it for the money. And there's a sense that they feel like somehow they're betraying their idea or betraying their employees or betraying someone if they sell. And I wonder how and what advice you would give someone who's struggling with that reconciliation. They've got a business, they've made it be valuable. It may not be the next Tesla, the next whatever, Google, but it's valuable. And they're struggling with that sense of, I guess, guilt around selling out.
Yeah. And I think this is also where recognizing, like, am I actually selling out? Or is this really about my ego and the fact that I really feel like I need to have control over things? And it's a tough answer. Like I'm not trying to give anybody advice. I wouldn't give anybody advice on this, John. I think, if there's anything I'd say, it's actually like I needed to look inwards. And nobody knows what the future holds, right? I got to, I was talking with the founder of Mercury Bank yesterday. And, to hear their story, like there's all of these different twists and turns, right? Who would have predicted that the pandemic was going to happen and all of a sudden neobanks were going to get, like all this influx? Who would have predicted that Silicon Valley Bank would have had its implosion, right? And therefore they would get all of this business, right? You just don't know. And so, you have to, for me, like I needed to stay, how can I stay prepared for the opportunity? And I think the mistake that I made was thinking that, and this is what I mean about thinking that it was actually about me. It's not about me. And instead, like I wouldn't necessarily say, okay, like, let's go, Dave, like there's this super unethical company that wants to buy your company and like it's going to maximize shareholder value, but they're going to fire half of your staff on day 2, right? Like that might, I might say, no, that's not the kind of place that I want my baby to land in, right? Mm-hmm. But and maybe a good example of this is just thinking about this as a parent, right? Like as a parent, and I have 2 amazing kids, but like what my kids do, that's what, like, I'm proud of them, but like I'm not accomplishing those things. They're accomplishing those things. And when they achieve something, it's their success. yeah, maybe it's a tiny little bit reflected upon me and my wife, but it's not really about me and my wife. So can I take that same kind of ideation and attitude and say, wow, like, have I raised a good child? And can that child now go into wherever it's going to? And is it going to be led by an executive or a management team that maybe I'm a part of and maybe I'm not? But that it's going to be okay. And that all of these people who work there are still going to get taken care of? Or is this a crush it up and split it into parts and, and destroy it? And again, so I'm not looking personally for what's the maximum amount of value that I can drive out of this. But I also need to realize it's business. It's
Right.
business. And so, that those are the kinds of questions that I wrestled with. Like in our case, they wanted there was an earnout piece to it. And part of the reason why I turned down the offer was they kept changing the numbers on me when we were negotiating as to like what that earnout would be. And therefore, like, yeah, it sounded like we would get all of this money, but that was 3 years from the future, and it required a bunch of things that like I didn't have direct control over, like how much so part of this was it was going to a large company that had a huge advertising sales force. But I didn't know 2 years from now, while my bonus or my payout is still part of this, would they still be as interested in the blogosphere and selling, influencer networks as they are today? I mean, I knew that this was a company that had a lot of internal reorgs. We used to talk about our relationship with this particular company, like playing the game of Survivor. I don't know if you guys remember that like where they like the marble game when we were kids. I'm totally showing how old I am now, right? And like that the Sands would every 6 months they would have a reorg. So those were the kinds of things that also went into my mind of like, I'm not so sure that what they're actually proposing here, I have the kind of control to make sure that I'm going to be able to get that payout that sounds so good.
What proportion of the overall deal that you turned down would have been quote unquote at risk in an earnout?
Good question. Boy, I have to go back to the actual documents. I don't remember it off the top of my head, but it was on the order of about 40%, right? So there was a piece that was guaranteed that we would have gotten paid out. And it certainly involved making our current investors whole and then some. But there was a very large piece, like about half of it, that had to do with meeting additional goals over the next 3 years.
Got it. Yeah, it's interesting. We started this conversation around investors and the Technorati story because you've had 9 companies. Offbeat Guys was I'm assuming one of the smaller, and then Technorati was a very big raise, and everything in between. I guess one of the questions, the philosophical questions I'm really curious about and how you would answer the question, is it better to own 100% of a small pie or a smaller slice of a big pie? I realize that's a decision we all have to make at some point. I'd be curious to know your answer.
I'd say if I had my druthers, the best is to own a majority stake or at least a controlling stake in a very large pie. I don't think it's about owning 100%. Right? We used to talk about this in terms of, do you want 100% of a grape or 10% of a watermelon? Right? And as the person who is not only getting a financial reward, but also is actively working and is, trying, like, bringing the vision to life is more than half of the reason why I do what I do. There is a bright line that happens when I sell enough of the company that I no longer have a controlling stake. So I think that to me, and by the way, the best way to do that is build a ton of value early, right? The more value that I can build early, the more that I've then like brought a competitive process into the raise, the less that I have to sell of that controlling stake. And by the way, all the other equity holders do well too. So that's how I like to think about it today. I'm not opposed to the raising of money, but like, you know, what I did with Warmstart, for example, right, is like we've only taken a very small, like an angel round, because I realized, wow, the business physics here around AI are totally different. Like that an incredibly small team of really dedicated people can get a ton of things done that you don't need to hire as many people as I would have used to hire. I don't need to have all of that capital. But what I did need is like, I needed to understand the business physics well enough, early enough to be able to do some advertising to understand like what's my cost of customer acquisition, to get enough people in and pay the salaries of them so that we could have the product itself built out to get revenue from it. But like that's a very, very different model from saying like, let's go out and blanket the world and hire hundreds or even dozens of enterprise salespeople where the payoffs are going to be years away. That would require a much larger raise.
And you brought a really nice point into focus, this bright yellow line. When you're no longer the majority shareholder, it's tough to bring your A game. It's tough to bring that vision, that energy when you're no longer. And I guess I'd be curious. It sounds like with Warmstart, you have that majority position, and that's great. I guess, where did you learn that lesson? Which of the 9 businesses did you give up that majority chunk and then just feel your energy kind of wane a little bit?
Well, it might have actually happened in my second company. So my second company was called Linuxcare. So this was the first company that me and my 2 other co-founders had raised venture capital for. And I mean, this was Kleiner Perkins. Like this is, you know, the folks who gave money to Google and Netscape and Yahoo. I mean, this was like an incredible, amazing pedigree, terrific people. And like, we raised over $100 million for that company because we realized also that like we had contracts from Dell and IBM and Hewlett Packard and like these enormous corporations who the opportunity to scale out was just limited by our ability to be able to service them. But what ended up happening was we grew from 3 of us, me and my 2 co-founders, to over 480 people in 18 months.
3 to 480 in 18 months?
18
That's
months.
Nuts.
And I still remember coming back, like I had just, so I've lived in Japan. I speak Japanese. I had my co-founder and I, so we went off for a month to Japan and we opened up our Japanese offices and we had partners with Panasonic, Fujitsu, Uchida, and like, you know, Mitsubishi and all these amazing, amazing partners. And I remember coming back and we had gone from about 150 people to maybe 250 people during that month. Because again, remember, like this was the go-go times of, you know, the late 90s. And, you know, there's always more money where that came from, Dave, right? You know, like go. And we had great customers, but I remember coming back with my co-founder and looking around, and there were all these people with Linuxcare badges, and they were like, "Hey, Dave, hey, Art," and I remember looking at him and going, "Like, do you know what that is?" And he was like, "I don't know who that is." I'm like, phew, like I don't know who that is either, right? And one of the mistakes that we made, because again, I mean, you know, you just gotta trust. You have to trust. We trusted some of the wrong people, let's put it that way. And we made a poor hiring decision. And by the way, we didn't have control of the company. Like we each owned about 10% of the company at that time, but we couldn't override the board on the choice of the experienced CEO. And frankly, it just turned out that this was totally the wrong person. He had a great sounding resume and totally didn't understand the company, the culture, what we were trying to build, and that it fundamentally clashed with this open source community. And so we ended up, because of that, not able to get rid of him. And I look back on that now, like, I'm not opposed to hiring somebody to do my job, right? Like hell, man, if you can do my job better than me, I will hire you on the spot and I'll pay you more than me. Great. But when we realized that we were no longer able to make the moves that we needed to make, when we realized that we were in the wrong decision, then it was about 18 months of pure hell. And I thought that for Technorati, I was making the right decision or better decisions. And overall, by and large, we were. Of course, at a certain point, we needed to take more money where I didn't have that kind of control anymore. But if I were looking back on it now, like, that requires growth. You've got to be able to meet those growth targets. Otherwise, where's the money going to come from to pay your monthly spend for 80 employees, 100 employees, 120 employees, right? Like, you can spend $1 million like that in like under a month by just having a bad month when you have 80 employees.
Yeah. So what ended up, you mentioned 18 months of sheer hell with Linuxcare. Like, what was the end result?
Yeah. We actually got to the point where we were ready to IPO, and we had Credit Suisse and we had Goldman Sachs as our bankers. And there were some abnormalities that we found, right? There were some lawsuits, some things that came up, and that it turned out that there was some things that were going on at the company that caused the board to take a hard look at things. And that company was valued. We were getting ready to go out at a $2 billion valuation. And at that time, I still owned 6% of the company. Each of the co-founders still owned 6%. But you know what? And to their credit, the board did the right thing. I wasn't on the board anymore at that time. But the board did the right thing, and they pulled the IPO. And this was in March of 2001. And if you remember those times, right, the big crash happened in April of 2001. So while we fixed the business and we had to make some changes at the executive level, the window for IPO just didn't reopen. And so in the end, what I was hoping was going to be a really significant, very material, that's a 10-figure exit, never materialized. That's one of my, $100 million scars that I learned, was being really judicious about maintaining as much or judicious control, and then also looking at how important hiring decisions are, especially when you're bringing in people who are going to be, executives and guiding the company forward. So better to hire slow and fire fast was one of the big lessons learned.
So am I getting it right to say the company actually went out of existence, or did it just not IPO?
It went through a couple of other transformations afterwards, but certainly the common never made a penny back, right? I think some of the preferred investors got some of their money back, but it didn't. It just, we went into that winter in 2002, 2003, 2004, and there were we had to go through, I think, 2 or 3 rounds of layoffs, at which point, like, I had left the company at that point. And, all I can say is I just have such deep respect, and I feel a bunch of regret for some amazing people who left their jobs to come and work at this first open source company. And, I wish that I personally could have done better by them.
What's that like to see on paper like I'm doing the math, 6% of 2 billion is like 120. So I got to reran it so we can talk more about it. But but it's $120 million. You must have been a very young man at the time.
I was in my early 30s. That's right.
Yeah. Like, what's that like to go from, quote, on paper being worth like 9 figures, like to not in your early 30s when, that must be devastating.
Yeah. And I was, like not paying enough attention to my family. And, we had a young family. Like my daughter was born at the time, but, my poor suffering wife, who is an absolute angel, right? Like, and I think about what the mistakes that I made during that time, and the regrets, if I'm going to have any regrets, I don't have many regrets, but like, if I have any of them, it was, wow, like what I ended up putting my spouse through as I was going through both the rise and the hyper growth, and everything is great, rah, rah, rah. Don't worry about this, honey. I know that I'm coming home late at night and I'm carrying 2 phones and I'm not paying attention to you and the baby as much as I could. We're going to get through this and, it'll all be good. And then realizing, actually, no, you never get that time back. And those promises don't always work out. Making sure that I'm taking care of my family is one of those big lessons that I learned from this. Money is money. You know what? Money is money. But like, you never get that time back. And those relationships, once they adapt, it takes a long time to repair the relationships. Those are the things that I learned the most from it.
But we started this kind of conversation with this idea of it's good to own the majority of your business.
Yes, no doubt.
A big pie. Yeah.
So again, and these were some of the big swings. These were be intentional. So for me, I don't think I was thinking this stuff through to that level. And if I were looking back on it again today with the hindsight that I have, which is why I'm building this current company very differently, and why I built other companies, differently. I think that the idea of growth at all costs and, like it's a win when you raise money because you can get in TechCrunch or, whatever. No, man, like that's like saying, I just took out a mortgage on my house. Let me send out a press release. Like you haven't actually built anything, Dave, right? Like the real true test of a business is, can you build a really good, profitable business? Can you do so where the amount that you are de-risking the company, right, does not overshadow what you have to spend in order to de-risk the company, right? And I think that's the fun piece here. So we intentionally knew we were going to go big, we were going to go fast, and during that time, while we were growing, we went through all of those growing pains. Looking back on it today, I say, wow, you know what? So many things that I do differently today, like understand my business. What is my business? Make sure that I can make it repeatable before growing at that level, and then raise the money. But first, figure out what my actual business is, be able to run it profitably when it is at that smaller scale, understand the processes and the people that I need in order to scale it. And then I can raise, and when I'm raising money, then it's like the money is a cash machine, right? I put in $1 and I get out 3. That's money that I'll raise any day of the week. But putting in money and then getting out 50, putting in $1 and getting out 50 cents. But don't worry, in 3 years, it's going to be $20. That's a very conscious risk that I don't think I took seriously enough at the time.
So now I love this concept you've raised today called business physics. I've heard it referred to as kind of unit economics, but the kind of core math behind your business model is so important, and it's enabled you to retain more than the majority of Warmstart. For folks, before I let you go, just describe Warmstart. What is it, and how can people use it? Just give me the quick overview.
Great question. And it came out of starting eight businesses before it, right? And I think one of the key questions that I had, so I was building business number 8, and it was this cool AI company that like basically did deep research. Right? It was agentic. This was 3.5 years ago. You could go give it any question and it would go out, send agents out over the internet, because I knew a little bit about search, pull in all this different data, summarize it for you, find the stuff that makes sense, and then write you a summary with a bibliography. Right? It was terrific. And today, OpenAI has it, Perplexity has it, Anthropic has it, right? So I realized I knew pretty quickly that there was no deep moat here. But I was also incredibly interested to see, like, would other people find this as interesting for me as it was for my, interesting for them as it was for me. And so, of course, what do? I send out a bunch of emails to people. I've been in this industry a long time and got some great response back. Got me on some podcasts. We got a bunch of customers. I was like, this is great. And then I found myself sitting at my computer one day saying, I know more people. I know that I've built this great new mousetrap. And for the life of me, I can't think of anyone beyond that 30 people who I already sent an email out to. And what struck me, and this was the fundamental insight behind Warmstart, was that when we are reminded of things, we're way better at recall than if we're just trying to remember things, right? So in other words, human beings are great when we're reminded, and we're terrible at just remembering. So what hit me was, like, Dave, you just built this agentic system that can go out and like do all this research. Why don't you throw it against your email archive and ask it questions? And it took, about 6 weeks. I built the initial prototype, and it was bringing up contacts, people who I haven't talked to in years. And it would find out, they work at a different company, and so on and so forth, right? But here's how you would reach out to them. And I started doing this, and I ran a campaign, and I actually had to stop it after 10 days because the response rate was 46%. We had so many people who were responding. And it's because I realized that we talk about outreach today, and it's always cold outreach. Like, go reach all the plumbers in the world. Like, they don't want to freaking hear from you. But you know what? Like, there are people who already know you and like you, and they just haven't heard from you in a while. And if you could actually take the time to send them a personalized email that talks about them, the opportunity that they'll respond goes way up. And so we call this warm outreach. And again,
hence the name Warmstart.
Hence the name Warmstart, right? So get started. You can get started by like literally just connecting your email to it, and it indexes every single conversation that you've had with every single person who you've ever talked to. And then it goes out, finds their social media, because very often those emails don't work anymore, right? Or like they're working for a different company. And it builds you an evergreen dossier on them. And it reads their blogs, it reads their LinkedIn, it reads so like you get to stay up without having to go and surf and doom scroll all day. And then each morning I get between 5 and 15 pre-written email drafts that I look at. And we even do a little bit of stuff where like it learns how you write, because it looks at your sent folder, right? And so on. So the AI starts out a little AI-ish, and then it gets better and better. It actually adapts over time. That like essentially I spend 10 to 15 minutes each morning looking and just saying, does this one look good? Oh, wait, like maybe I want to add a little bit here or change a little bit there. Or sometimes I'm like, ooh, I kind of want to be passive aggressive. And like this person, maybe they just got promoted and I really don't want to be able to send them anything, right? So I can delete it. And what we found was that, especially for builders and founders, people who are in that sort of like $1 to $10 million ARR range, where you're doing a lot of sales as part of your job, which is what I've always done, that like the idea of doing outreach sounds like something that we all should be doing, and we're all way too busy to do it. So I just wanted to make it incredibly easy that you wake up, you click on that email, you go, you send out your 10 or 15 outreach emails, right? And you're done with it for the day. And, you know, most of our customers within the first week get between 2 to 6 new business meetings set up.
Wow.
Every single one of them so far. Yeah, every single one of them so far that's done this for 60 days in a row has made enough deals and contacts and contracts that it pays for the entire year of the service or more.
It's so cool. Okay, it's called warmstart.ai, and we'll put that in the show notes. Dave, is there a place if people wanted to reach out to you on social? Are you an X guy or Instagram, or what's the best place to reach you if they wanted to say hi?
Yeah. So I, as a former blogger and social media junkie, I have pulled way back, but where you can still see I post frequently is on LinkedIn. We find that most of our ICP is on LinkedIn, and that's been the place where I spend my most time.
Awesome. And we will put links to Dave's company, warmstart.ai, as well as your LinkedIn profile in the show notes at builttosell.com. Dave, thanks for doing this.
John, it is such a pleasure. Thank you for taking me back through so many decisions. I really just hope that this can be some of my experience, and maybe some of these scars can be helpful for somebody who's going through something similar.
I'm sure they will be. Thanks, Dave.